All right, greetings. Here we are again. We are going to conclude chapter 5 today. And I hope you all did your homework. We did a homework check here for the face-to-facers. And most people did it, but there were people like Jay Yoon and Jake that didn't. So, no, I'm just kidding. But they didn't do it. So if your parents are watching, wow. Hopefully you folks at home did it. If you did, pat yourself on the back. If you did not do the homework, smack yourself across the face, okay? You got to do this stuff to learn it. You have to do this stuff to learn it, all right? And I know it was a lot, but some of them were pretty short, were they not? Some of them were really short, okay? By the way, just to go to the ELMO real quick, I got a nice email from somebody who watches these lectures and they're overseas. And I always enjoy getting those. If you're ever watching I'm talking to the people right now that are not enrolled in this class, either face-to-face or on the online way. But if you're watching these and they're helpful to you, I love to hear from you. Shoot me a quick email. Let me know. I get lots of interesting stories from people overseas that are watching this. It's always kind of cool for me to hear from people in other countries that somehow stumble upon these on YouTube. And it's kind of nice to know that we're going to the effort of taping these, that somebody is watching them. So, okay, let's go through the homework right now. I'm going to jump around a little bit. Let's go ahead and go to exercise 5.4. Let's start with that one, okay? Exercise 5.4. I always think this is a little weird how they set this one up, but let's get through it, okay? Exercise 5.4. Spare Parts was organized on May 1st, 2011, and made its first purchase of merchandise on May the 3rd. The purchase was for 1,000 units at a price of $10 per unit. On May 5, Spare Parts sold 600 of the units for $14 per unit to DeSoto Company. Terms of the sale were $210 net $60. Prepare entries for Spare Parts to record the May 5 sale and each of the following separate transactions A through C using a perpetual inventory system. Okay. Now the first thing I want you to do is I want you to be shifted into the right gear. Are we doing transactions on the purchase side or on the sales side? The sales side. Okay? Sales side. So first of all, let's make the journal entry for, let's see, the first journal entry they want us to do, oops, I grabbed the wrong sheet here, just one moment. The first transaction they want us to account for is actually the May 5th sale. Is that correct? Is that right? It's not denoted by a letter A, B, C, or whatever, but they want us to account for the May 5th or the May 5th sale. So let's take a look at what those journal entries are. All right, let me square that up a little bit on the overhead. All right, I think I could make that a little more readable. So we actually have two journal entries, don't we? We have a debit to accounts receivable and a credit to sales for the 8,400, correct? 600 items times the selling price of 14. And then we debit cost of goods sold and credit merchandise inventory for $6,000, which is the 600 times our cost. Okay? So we have two distinct journal entries. Make sure you don't get those all mixed up. Kara?
Never mind.
Okay. Glad I could be of help. Okay. All right. So that is the entry for May 5th, right? Now they want us to make the journal entry for May 7th, A. On May 7th, DeSoto, now who's DeSoto? DeSoto is our customer, right? They return 200 units because they did not fit the customer's needs. And we restore the units to our inventory. Okay? So we take those 200. The journal entry is such. 200 times the sales price. We reduce our accounts receivable by $2,800. We don't debit sales. We debit sales, returns, and allowances. Remember, that's a contra revenue account. We reduce our cost of goods sold because in the end, these were not sold. And we debit or increase merchandise inventory because there was nothing wrong with these. We're putting them back on the shelf for some other customer to purchase, right? So this is almost, these are almost a flip-flop of the above, except for we do not debit sales, we debit sales, returns, and allowances. Okay? Cool? Any questions on that? Let's go to B. On May 8th, DeSoto discovers that 50 units are damaged, but are still of some use, and therefore they keep them. Spare Parts, that's us, sends DeSoto a credit memo for $300 to compensate for the damage. Okay, now this is an example of what? A purchase allowance. There is no return of goods. We're just going to give them a credit memo, which kind of just means we're going to knock off $300 from what they owe us. Kara?
So on Part A, May 7th, can you just write sales returns, and then on the 8th, can you write sales allowances?
Yeah, you can do that.
Okay, you don't have to have both.
She was asking if you could just do on the May 7th entry, if you could just use the account sales returns, and then on the May 8th, you could do sales allowances. But a lot of companies just put that into one account, sales returns and allowances. So either way is fine because that's contra revenue account.
Okay.
But for transaction B, where we give them a credit memo, there's only one journal entry because we're not restoring anything to inventory. We're just decreasing our receivable by $300, and we are debiting sales, returns, and allowances for $300 as well. Cool? All right, questions? I'll say this again. This is the chapter where when you just watch these being done, it looks so easy. But when you have a blank piece of paper in front of you, all these accounts seem to kind of jumble in your mind. And you don't know which ones to put where. So don't be under a false sense of security that you understand it just because you're watching me do it and it seems to make sense. Okay? Okay, we have one more transaction, transaction C. On May 15th, DeSoto discovers that 72 units are the wrong color. DeSoto keeps 43 of these units because Spare Part sends a 92 credit memo to compensate. DeSoto returns the remaining 29 units to Spare Parts. And then Spare Parts restores the 29 returned units to its inventory. Okay? Now, I think this is actually easier to do in 2 journal entries. Well, actually, when it's all said and done, there's going to be 3 journal entries, but I'll show you what I mean. Here's the journal entries. I think it's easier to make a journal entry for the $92 credit allowance, okay, and then do a separate journal entry, same account debited, same account credited, for the items that are being returned. The 29 items times the $14 sales price. Now you could certainly combine those into one entry if you wanted to, okay? That would be what, $498 if you combined these 2 journal entries, okay? But I think it's easier to kind of handle these separately because for those 29 returned units, we restore those to inventory at cost of $10. So once again, we increase or debit merchandise inventory. We decrease cost of goods sold, which is reducing it because those items were not sold. Correct? All right, does that make sense? Any questions on that? All righty. Well, let's go to exercise 5.2. Now, exercise 5.2 I encouraged you to do this. I encourage you to do this on a side-to-side situation, right? Okay. Let's see if I can fit that on the screen. If not, we'll go to the written solutions. Okay. Okay. Taos Company purchased merchandise for resale from Tucson Company with an invoice of $22,000 and credit terms of $310 net $60. The merchandise had cost Tucson $15,000. Taos paid within the discount period. Assume that both the buyer and the seller used the perpetual inventory system. Okay, they want us to prepare the entries for the buyer, and then they want us to prepare the entries for the seller. Correct? All right. Who is the buyer? The buyer is who?
Taos.
Taos. And who is the seller?
Tucson.
Tucson. Let me grab a chair real quick. Hope I don't knock over something important. Okay. That seemed like that would have been something good to do before we started taping, doesn't it? Well, maybe so. All right. Let's go ahead and do this. I want to try to do this on a side-by-side basis. Okay? All right. So we have our, let me zoom out as much as I can. Let me know, you folks out there, if I start to write and it's not on the screen, okay? We have our buyer, which is Taos, or however you pronounce that, okay? And then we have our seller, which is Tucson. Is that correct? Okay. I'll try to keep my shadow out of this. Okay, so we have our first journal entry, which is when Taos purchases the inventory. Is that correct? All right. So what we do here is we debit merchandise inventory and credit accounts payable for $22,000. Is that correct? That's 22,000. It kind of got a little, started to bleed together there real quick. Okay? Let me just draw a line down the middle of this to keep these separate. Okay? All right. Now, how does that look for the seller who sold these goods to Taos? Well, if there's an accounts payable for 22,000, these folks have an accounts receivable for 22,000, right? And we credit sales for 22,000. Does that make sense? Now the seller has a separate journal entry to make, don't they? And that's where we have to record the cost of goods sold and decrease our merchandise inventory for whatever the cost of that was. Now, what was the cost for the seller? How much? $15,000. Okay. Now they only had one entry. They have two, right? For this transaction. Is that correct? Okay. Sometimes I think that's kind of nice to see them side by side, though, like that. Okay. Now, did the buyer, when they paid, did they pay within the discount period? Yeah, they did. So they don't have to send $22,000 to the seller, do they? They only have to pay. Well, what's the credit terms on this? It's $310. It's not $210. It's $310, isn't it? We've been doing all twos. Okay, so they don't have to pay $22,000. They pay 97% of $22,000. Is that correct? So they only have to pay cash of, what does that figure out to? $21,340? Now the entire accounts payable goes away of $22,000. Where does that discount of $660 get credited to? Merchandise inventory. Correct? Is that the entry you all got? Now, if they put cash in the mail, a check in the mail of $21,340 and send it to the seller, when they open up that envelope, how much cash is in there? By golly, $21,340, correct? Now the entire accounts receivable goes away, doesn't it? Because it's satisfied. So they credit accounts receivable for $22,000. Well, where does that extra $660 go to? Get debited to? Where does it get debited to? Not inventory, not merchandise inventory. Sales discounts. Sales discount. Okay? So there was no second entry up here. Does that kind of help to see it side by side a little bit? All right. Questions on that, folks? Can you see that okay? Can you see that okay? Here, I'll put this up there too, if it's easier to read that one for the folks who are watching this on the computer. It's not side by side, but it's pretty much the same thing, isn't it? Okay, so just leave that up there for a second if you would, please. Okay, any questions from you folks about that one? I want to be sure to answer any questions you might have. All right. No? Well, all righty. Then let's hop over to yeah, I'm trying to decide which I want to do first. Let's do exercise 5-7. Okay? Exercise 5-7. All right, exercise 5-7. Business decision makers desire information on sales returns and allowances. Explain why a company's manager wants the accounting system to record customers' returns of unsatisfactory goods in the sales returns and allowances account instead of the sales account. Explain whether this information would be useful for external decision makers. Okay? All right. Why would this be helpful? Why don't we just, when there's a return or an allowance made, we could just debit sales, right? But instead we're using that contra revenue account of sales, returns, and allowances, right? Why would we keep track of that in a separate account? Why would that be useful for a manager? Any ideas? Yeah.
That way you know that you sold it, but it was returned, and that way when you're looking at it, it doesn't look like you just didn't sell anything.
Yeah, I mean, let's take an extreme example. Let's say you sold 100,000 of goods, and 60,000 of them were returned, and you only had net sales of 40,000. Now, if you just use sales, it would say sales 40,000. But doesn't it give you a lot more information as a manager to say, we sold $100,000 worth of stuff and 60 of it was returned? It might give indications that if that was the case, that our quality, there's something majorly wrong with our quality, right? Okay? Majorly wrong with our quality. Okay? And this would also be important to external users too, people who are thinking about the company. Customer satisfaction, quality standards, those things are very important, okay, in the life of a company and making sure you're going to be around for a while, correct? So basically what it does is allows that piece of information to be apparent, okay? If we used sales instead of sales returns and allowances or sales discounts or those sort of accounts, if we just use sales, all that information would be jumbled up together in the sales account, and it wouldn't be as readily knowable. Make sense? Okay. Now notice something though. Do we have a purchase discounts account? Do we have a purchase returns and allowances account? Do we have that? No, we don't, do we? We do not have a purchase. If you're in a perpetual entry perpetual inventory situation, and you guys on your test or your quizzes are debiting or crediting purchase returns and allowances or purchase discounts, you're making a mistake. Because those are all going to merchandise inventory, aren't they? Now, we might keep track of those separately, but we do not use accounts on the books. There's no T account called purchase returns and allowances or purchase discounts, okay?
Why do you put are you planning on using that inventory again? Why would you put it back in your merchandise inventory? Would you be able to resell that stuff?
Well, if somebody returns something and there was nothing wrong with it, yeah, we could put it back on the shelf.
So we're assuming that nothing's wrong
Yeah,
with it.
if there's something wrong with it, if it's all broken or it doesn't work and somebody returns it, you don't put it back on the shelf, do you? Unless you're Walmart, then you would. I'm just kidding.
So why would you put it? What account would you refurbish it?
You might refurbish it, right? Yeah.
But you'd still put it in your inventory?
No, if it's broken or whatever, you're not going to... Well, let me just show you. Going back to exercise 5.4. Okay, take a look at 5.4 transaction C. Okay, right here they returned some goods to us. Concentrate right here. Right here they returned some goods to us and we returned them to inventory. So we debit or increased merchandise inventory, right? But if those items were all busted up and broken or something was wrong with them, we wouldn't debit merchandise inventory. We would probably end up debiting something like damage expense, or we'd have maybe some sort of expense account, like merchandise breakage expense or something. That sounds official, doesn't it? Or we could create a loss. What we call a loss account. We haven't talked about that yet, but we will in the future. Kara.
So if you were to debit like a broken whatever, what would you credit?
You would still credit cost of goods sold because we're reducing in the end these items were not sold, so we would have to credit or reduce cost of goods sold.
Okay.
But we wouldn't be increasing our inventory. We would be debiting that sort of expense. So those are good questions. Great questions. Okay. Other questions? You know, in this class, we kind of try to teach you the normal stuff, but there's always exceptions to it, isn't there? There's always exceptions. There's always weird little situations. You guys are a pretty good class. Every now and then I have a class that they're constantly asking about the special situations. What if you returned an item, but then it was stolen before you returned it to inventory, but then you found it in the trash dumpster afterwards, and then you tried to return it, but an employee stole it? What would you do then? And it's like, well, we can go through that, but I don't like to confuse people, right? So you guys are pretty good. So the questions you're asking are good questions. And the real weird cases I try to stay away from. And let's learn to walk before we run, right? So, okay. Let's go to, we did 5.7. Let's go to 5.13, okay? 5.13 was in regards to the current ratio and the acid test ratio. Now, what was the current ratio? What did the current ratio measure? We talked about this a few chapters back. It's current assets divided by current liabilities, and what does it help analyze? The ability to pay short-term debt. Very nice. Now, the acid test ratio does the same thing. But we don't have every current asset in the numerator, do we? There's only a few of them that we put in the numerator. Which ones are those? Cash, cash equivalents, short-term investments, and receivables. Is that right? Okay. Now let's go ahead and do this problem, and then I'll kind of flesh it out and explain why we have the acid test ratio. Okay, so on exercise 5.13, it wants us to compute the acid test ratio for those situations and the current ratio as well. Okay, let's take a look first at the current ratio. And we learned how to compute the current ratio few chapters back. Okay? Okay? So in this case, the current ratios were 1.82, 3.18, and 2.0 for case A, B, and C, respectively. All right? Is that what you all got? Did you get those? Some people say, well, how many decimal places should you take it to? I like to take it to 2 decimal places. So don't round that to 1.8, 3.2, okay? Put 1.82, 3.18, and 2.00, okay? Now, looking at this, which of these, if you just simply look at what's on the screen, which of these cases do they have the highest and the best current ratio? Case B, right? They have a current ratio of 3.18. So if you're simply looking at this measurement, you would say case B has the best ability to pay short-term debt, right? Case B would. Okay, now let's do the acid test ratio. The acid test ratio says we're not going to use all current assets in the numerator. We're only going to use cash, short-term investments, and current receivables. Those are called the quick assets. The quick assets. Let me straighten this up for you. Okay? So the quick assets for case A, B, and C are 800, 1,300, and 5,100 respectively. Now we take that divided by our current liabilities, and then we get our acid test ratio of 0.36, 1.18, and 1.40. Okay? Now, if you simply look at your acid test ratios, who has the highest acid test ratio? C. If you're looking at the acid test ratio, then company C has the best ability to pay its short-term debt. Well, why the discrepancy between the current ratio versus the acid test ratio? Well, you have to be careful with the current ratio. Why did case B have a high current ratio? Well, they had high inventory and they had high prepaid expense, didn't they? Okay? But here's what you have to understand, and here's why we have the acid test ratio. There's a big difference between having $1,000 of cash versus $1,000 of inventory, right? Which one of those is going to help you pay bills better? The cash. Because your inventory, and we'll talk about this in chapter 6, what if your inventory is what we call dead inventory? Inventory that's not worth much and probably nobody wants to buy it. Well, still, technically, it's a current asset, but is that going to be helpful to pay your bills? Okay. What about prepaid rent? What if you prepaid your building rent? Well, that counts as a current asset in the current ratio calculation, not in the acid test, right? Well, prepaid rent, if you have a bunch, let's say you have zero cash but a ton of prepaid rent, is that going to help you pay your bills? No. You see what I'm saying? So the acid test ratio says, okay, let's not count these current assets that are really, that may or may not help us pay our bills. We're going to look at the liquid ones. Cash, short-term investments, and receivables. Valid current receivables. Okay? When I go out to my clients and we do this ratio, they like the current ratio, but a lot of times what we'll find is they have dead inventory on the books. And they have old receivables on the books. And they're trying to count that as, well, these are current assets. And maybe they have to report their current ratio to their bank. And we're like, you know what? These may look like current assets, but they're really not. These are receivables that are very old. They're not going to get paid. This is inventory that is dead. And we have to get these out of your assets and out of your current assets and write them off as expenses, and they do not like that. No, they'll pay, and we'll go, this receivable is 3 years old. No, they're going to pay. They went bankrupt. I read about it 2 years ago. I think they're going to pay. They're not going to pay. Take it off your books. Okay? Did you have a question, Matt?
I was just going to say, your current receivables, how close to upcoming can they be? Like,
Very good question. Current receivables, I kind of assumed you knew what I meant. Current receivables, if you want to go real current, you would say they have to be receivables that are like,
within 6 months?
they're not older than 90 days.
Oh, okay.
If you wanted to be more strict, you could say they're not older than 60 days.
Mm-hmm.
Okay? But a receivable that is 270 days old, what's the chances they're going to pay that thing?
Plus, it's not very liquid.
Not real good. Okay? All right? Sometimes companies are like people. Sometimes people don't like to face the truth, right? Sometimes people who are in financial trouble, they don't know how much they owe, and they really don't want to know. Kind of like sometimes with a weight problem. You ever watch The Biggest Loser? My kids love that show. Well, a lot of these times, these severely overweight people, they don't want to weigh themselves because they don't want to know the bad news. And they make them weigh themselves on that show, and they have to face what the situation is. And that's the first step to becoming healthier, isn't it? But they're like, I haven't weighed myself for 2 years because I knew it was bad news. Well, sometimes companies do that too. Well, I don't want to know. I don't want to know. Well, you have to know, don't you? It's always better to know. And then you can truly make those steps towards being a healthier company as well. Okay? All right, that's good exercise. Any other comments or questions on 513? Okie doke. Let's move right along. I think that's all our exercises, isn't it? Now let's go to our quick studies. Quick study 5.5. Okay, quick study 5.5. Compute net sales, gross profit, and the gross margin ratio for each separate case A through D. Interpret the gross margin for case A. Now I wanted you to do some reading, right? Couldn't have done this if you didn't do your reading. But first of all, let's take a look at, before we figure out the gross margin ratio, let's figure out how you compute net sales and gross profit. Now, what I highlighted in yellow on the screen for Quick Study 5.5, what I highlighted in yellow was information that was given to you, correct? They gave you the sales discounts, the sales returns and allowances. They gave you the cost of goods sold. Well, we had to compute net sales, which is just sales, minus sales discount and minus sales returns and allowances. And then net sales minus cost of goods sold is gross profit. Sometimes we call that gross margin as well. Okay? So that's how we computed that. Now the gross margin ratio is simply the gross profit divided by net sales. Okay? The gross margin divided by net sales. And this kind of gives you an idea of the markup. The markup on a product. Now remember, this isn't all expenses. You could say to a company that has a large gross margin ratio, wow, they're going to make tons of money. Well, we don't know what their operating expenses are. This is not net income divided by sales. This is gross margin divided by sales. Understand? Okay? This is simply looking at what is our sales price versus our cost. Okay? A product that would have a high gross margin ratio would probably be like beer at a Chiefs game, at a Kansas City Chiefs game. What does a beer cost at a Kansas City Chiefs game? $8. $8 for a cup of beer?
You gotta get smashed before you go.
Right? What do you think the cost is of that beer to the Kansas City Chiefs? Yeah, when you buy beer in bulk, it's not expensive. So beer at a Chiefs game would have a very high gross margin ratio, right? Something that would have probably a lower cost of, or a lower gross margin ratio would be like milk at a grocery store. Okay, what does a gallon of milk cost? $3.50 maybe? I have heard that they don't mark up milk much. They don't mark it up much. And the reason is they're willing to not make a lot of money on their milk because what?
It's a necessity.
Well, it's a necessity and it goes bad quickly. So how many times I mean, my wife and I are like, we're out of milk. We got to run to the store and get some milk, right?
It's always going to be bought.
And do they put the milk at the very front of the store where it's nice and handy, you can just run in and get it? No. They find the farthest point of the store and they put it there. So you go to get milk and then you go, ooh, Cocoa Puffs are on sale. I like that. Hey, Pop-Tart. A new Pop-Tart? They came out with a new flavor of Pop-Tart? Let's try that. Hey, a big bag of Doritos, right? Oh, I need some apples too. Oh, and we're out of ketchup. And before you know it, you came to the store for milk and you've got a basket full of stuff, right? Well, they're willing to not make a lot of money on the milk. They know people are going to have to go in for milk a lot. They want you to come in their store and buy their milk. And they're going to put it at the very back of the store, and hopefully you'll buy a bunch of other stuff too. Right? So beer, high gross margin ratio. Milk at a grocery store, lower. You with me? Okay. All righty. So any other questions? Who has the highest gross margin ratio on this case? Situation D, correct? 47.9. Now, we don't know what their operating expenses are, but from that information alone, situation D has the highest. All right, let's take a look at quick study 5.6. All right? Nixit Company's ledger on July 31st, its fiscal year end, included the following selected accounts that have normal balances. Okay, and they give you a lot of stuff. At the bottom, a physical count of its July 31 year-end inventory discloses that the cost of the merchandise inventory still available is $32,900. Prepare the entry to record any inventory shrinkage. So here is the big deal with this. On their books, it says that their merchandise inventory is $34,800. That's what the books say. And they're perpetually keeping track of it. Their books say that they have $34,800 of inventory. But they did an inventory count, and it only said that there was $32,900 of inventory. Well, which is right? Which is right? The counts is right, as long as you haven't made a mistake in the count, right? Have any of you ever done an inventory count? You have? What did you count, Cassie?
Well, I used to work at a restaurant a couple years ago. So
You worked at a restaurant, counted ingredients and stuff like that?
Yeah.
Kara?
I worked at Victoria's Secret, so.
You worked at Victoria's Secret, okay? I'm sure there's a lot of interesting stories in that, but I'm asking here on TV. And you would count?
Socks, underwear, and bras. It was
Underwear and
horrible.
bras, okay. There you go. I've done a lot of inventory counts, never counted underwear bras. Okay, Jake.
I worked at a grocery store.
Grocery
That
store.
was awful doing inventory there. Because,
Okay.
like, cat food. There'd
Cat
be, like,
food.
80 things of cat food. You have to count each.
Did they do them like in the middle of the night by chance? Okay. Now I'm going to guess at Victoria's Secret that there was some inventory shrinkage.
Yeah.
And why is that, Kara?
Easy to steal.
Easy to steal, right? I mean, who hasn't gone into Victoria's Secret and stuck a lacy bra in their back pocket, right? Come on, right? No, I'm kidding. But seriously, it's not only easy to steal, but it's the sort of stuff people want to steal, right?
Because it's expensive.
It's expensive. Now, who do they worry more about at that store? Customers or employees as far as stealing stuff? Is it customers?
Mostly customers. They keep a good eye on employees, though.
Okay. A lot of places, they worry more about the employees than they do the customers. Okay? But there are certain stores, they really have to be careful with inventory shrinkage, with theft. Best Buy. Go to Best Buy and look up in the eye in the sky, and there's cameras everywhere, right? Because people who steal have a tendency, they want to steal things like CDs and iPods and stuff like video games and that sort of stuff, right? I always wondered, what if you were a Bible retailer? What if you what if you were a Christian bookstore and you sold Bibles? Would people steal Bibles? Well, you know? Can you imagine? I'm going to steal a Bible. That seems kind of, doesn't that seem? I would always think if you feel like you need to steal the Bible, maybe you need to get a Bible. Maybe you can just have it, and okay? But there's certain businesses where you've got to be more cognizant of people's desire to steal your product. Victoria's Secret would be one. Best Buy would be one. Anybody else ever worked in a place like that? Marlon?
Bars, like because their product are so marked up, they're just worried about how much money they're making. You know?
Yeah. Bars, though, would certainly. All right.
Supermarkets, employees are the main ones for stealing alcohol because they're all tagged. Or it's breakages. That's your shooting.
Breakages. That's another one. There's breakages, too. Nobody stole it. It just broke.
You don't mark it up straight away.
Yeah. But here's a situation where we have our inventory count is $1,900 less than what our records say it should be. So what do? Well, we make the following journal entry, which you should have read about in your books. We decrease our inventory by $1,900, excuse me, and we book it to cost of goods sold, don't we? We book it to cost of goods sold. Now, some people go, this is weird that we debit cost of goods sold because these items weren't sold. Well, I guess the rationale is we kind of consider this a cost of doing business, you know. If it was a huge amount, maybe you would treat it differently, but for your purposes, we simply decrease merchandise inventory so that merchandise inventory periodically will be updated to what the actual count was. Okay? This is still a perpetual inventory system, but even with a perpetual inventory system, where you keep track seemingly of inventory all the time, you still have to do a count every now and then. You always, no matter the type of business, every now and then you have to do a count. We'll talk about what happens if you don't do a count, Chapter 8. Bad things can happen. Okay? Questions on that? All right. Okay, let's fly through 5.7 if we could. 5.7 says to, Quick Study 5.7, says to refer to Quick Study 5.6 and prepare journal entries to close the balances in the temporary revenue and expense accounts. Remember to consider the journal entry for shrinkage that we just made. Well, what they are trying to get across is we have learned some new accounts in this book, or in this chapter. Those new accounts I highlighted in yellow on the screen. Those are temporary accounts, and those do need to be closed, a la Chapter 4. Sales is like our revenue account. It has a credit balance, thus we have to debit it to close it. Sales discounts, sales returns and allowances, those are not expenses, but we close them with the expenses because they are temporary accounts that have debit balances. So we close all the temporary accounts with debit balances at once. You with me? All right. Questions on that? Questions on that? And now, make sure if you don't, your cost of goods sold, folks, if it was a different number, if you put 102,000 in there, then you forgot to make that adjustment that we did above where you increased it by 1,900. So that's why that's 103,900 and not 102,000. Okay? Is that what you were wondering about back there, Kara? Yeah. That's 103,900 because they recalled correctly that they had to debit cost of goods sold for their inventory shrinkage in Quick Study 5.6. Cool? All right. Now,
Move it up.
yeah, sure.
Is there more to that?
Pardon me?
Did you not have to do the income summary to capital and everything?
No, we just did the first two closing entries.
Oh, okay.
Just the first two closing entries. But very good to notice that there are more closing entries than what we just showed, right? We just did the first two closing entries. Cool? All right. Any other questions? Okay. Now, I got a few minutes left, and I'm going to use them because the next lecture is a really important one I think you'll enjoy. And but I want to make sure I get through that entire lecture next time we're together. So we're going to actually do a few slides of Chapter 6. So this is Chapter 6. Now, when you print out the PowerPoints to Chapter 6, if you do that, you may want to just put 2 on a page instead of 3 on a page. Because on some of them, there's a lot of numbers. But either way, okay? All right, Chapter 6 is our continuation of inventories and cost of sales. Now, first of all, you have to determine which goods that you actually include in inventory. What do you think about if you're doing a count? Which goods do you have to include in inventory? And we're going to talk about items that require special attention, such as goods that are in transit, goods that are being transported. What about goods on consignment? What is that? What about damaged or obsolete goods? Now, we're going to jet through this pretty quick, so I want you to read about this in your book in the first few pages of chapter 6. Goods in transit. Think about if you're doing an inventory count at the end of the year, and as you are doing that count, there are goods being transported to or away from your store. Do you count those goods in your inventory, or do you not count those goods in your inventory? The question all comes to who is paying for that transportation. If you are paying that transportation cost, then you include those items in your inventory at that point. Does that make sense? And that's where we go to our FOB shipping point, or FOB destination, to decide who owns it, and who is paying for it, rather. But whoever is paying for it is the one who owns it at that point. What about goods on consignment? Merchandise is sometimes sold on consignment. This would be an example like, let's say there's a Hallmark store that sells cards and gifts and stuff. And let's say an elderly lady comes in and she says, hey, I make homemade earrings. Could you sell these in your store and just a little display here? And I'll give you $3 for every pair of earrings that you sell. Well, the store might do that just to be nice to the elderly lady and maybe make some money, right? Well, in that situation, the elderly lady would be the consignor, and the Hallmark store would be the consignee. And the consignor, even though they don't have the physical inventory, it's in the Hallmark store, the consignor, the elderly lady in that example, would include that in her inventory. It's hers, even though she doesn't have it. Does that make sense? What about goods that are damaged or obsolete? What about when you count goods? What if you're at Victoria's Secret and you count a dress and it's ripped? Well, that's damaged, right? You've got to get that out of your inventory. Sometimes goods are damaged a little bit, but they could still be sold, and so we don't completely take them out of our inventory, but we write them down to net realizable value. But you have to handle goods that are broken or damaged or whatever. Okay? Does that make sense? And lastly, you have to include all expenditures that are necessary to bring an item to a sellable condition. Okay? Let's take an example. Let's say I'm that piano retailer, and I pay $3,000 invoice cost for a piano. But I also pay $200 for delivery and $100 for insurance while it's delivered, and then I pay $50 to somebody to tune it. That inventory would go down in the books at $3,350. Not just the invoice cost, but all of those other costs that were necessary and reasonable to bring that item to a sellable condition. Does that make sense? And we've talked about that a little bit, haven't we? Okay. And lastly, we said, we already talked about this today, but you have to do an inventory count periodically to update your books to actual, no matter what type of inventory you do. Okay? So, let me give you your homework real quick, and then we will journey on our way, okay? All right. I want you to do, should have had this before, apologize. I want you to do Quick Study 610, Quick Study 611, and there's one more I'm looking for. Hold on. Maybe they don't have that one anymore. You wouldn't worry about it? Okay. Let's just do quick study 610. No, I found it. Whew! Okay. I'll write this down. Quick study 610, quick study 611, and exercise 6-1. Let me put that up on the screen. Yes, quick study 610, quick study 6.11, and exercise 6-1. Okay? We'll see you guys.